What real estate tax laws confuse investors most? Imagine trying to navigate a maze where the walls keep shifting. That's what understanding real estate tax laws can feel like for many investors. Some laws seem straightforward at first, but then suddenly become complicated. This confusion can lead to missed deductions, penalties, or even costly mistakes. Let's look at some of the most common areas that trip up investors, especially Black families working to build wealth through real estate. First, depreciation rules often cause confusion. Depreciation lets you deduct the cost of a property over several years, usually 27.5 years for residential real estate. But recent changes, like the permanent reinstatement of 100% bonus depreciation for certain properties placed in service after January 19, 2025, add layers of complexity. You need to know which properties qualify, how to apply bonus depreciation correctly, and how it impacts your overall tax bill. Misunderstanding these rules can mean missing out on big deductions or making errors on your tax return. Next, the qualified business income deduction allows real estate investors to deduct up to 20% of their qualified income. But eligibility depends on income levels, the type of real estate activity, and how you organize your business. For example, if you own rental properties as a sole proprietor or through a partnership, you might qualify. But if your income exceeds certain thresholds, your deduction could be limited or phased out. The rules around this deduction are changing in 2025, making it even more important to stay informed. Opportunity zones are another area that confuses many. These zones are designated low-income communities where investments can receive tax benefits like deferrals and exclusions. The rules about which investments qualify, how long you need to hold assets, and the timing of your investments can be tricky. For Black families investing in underserved neighborhoods, understanding these rules can help maximize benefits while supporting community growth. Estate and gift tax laws also often cause confusion. These laws determine how your property is transferred after your death and what taxes might be owed. The high exemption thresholds mean many don't pay estate taxes during their lifetime, but when it comes to passing down property, the rules about stepped-up basis and gifting can be complex. Proper planning can help Black families transfer wealth efficiently, closing the racial wealth gap. Interest deductibility is another confusing topic. The rules about which mortgage or loan interest you can deduct, especially for investment properties, have changed over time. For example, limits on the amount of interest you can deduct on loans over a certain size can affect your cash flow and investment strategy. Finally, property tax laws vary widely depending on where you live. Some areas offer exemptions or relief programs for homeowners and investors, but many are unaware of these options. Black investors and homeowners might face higher property taxes or lack information about available relief, adding to their financial burden. To make the most of these laws, Black families should focus on understanding depreciation benefits, especially bonus depreciation, which can speed up deductions. They should also consider investing in opportunity zones to get tax advantages while helping communities grow. Estate planning is vital to transfer wealth smoothly across generations. Consulting with tax professionals familiar with real estate and the specific challenges faced by Black investors is a smart move. And exploring local property tax relief programs can help reduce ongoing costs. In the end, the laws that often confuse investors are depreciation, qualified business income deductions, opportunity zones, estate and gift taxes, interest limits, and property taxes. Knowing these areas well and planning accordingly can help Black families build and keep wealth through real estate.